Good afternoon, good evening, good morning, depending upon which time zone you are attending this webinar on the tax proposals which were laid before the House by the Honorable Indian Finance Minister on 1st of February. And today we all have assembled under the auspices of the Northern Indian Council of Indo-American Chamber of Commerce, and pretty much with the theme of rebooting India, impact on Indo-US Bilateral Economic Ties. The tax proposals have come, and in India, pretty much the budget is a fanfare annual feature, because not only it presents the proposals for the coming year and a roadmap, it is also an opportunity for the government to present policy and make policy announcements. This year, we all understand, has been unprecedented in many ways. So without much ado, we have a very well-strung session, variety of thoughts, specialists from various areas, academia, tax policy, both sides. And without much ado, I just hand it over to my chief, Mr. Roy, who's our regional president, for his welcome address. Over to you, Mr. Roy.
Thank you, Asim. While it's always a tough task doing the welcome address where you sit between such an eminent panel that Asim is going to moderate, who will bring in different aspects of the budget. He's been kind enough to ask me to talk a little about the opening remarks. But I can only lean upon what that the union budget of 2021 was the first ever digital union budget. No paper budget was presented, and I come from the IT world, and that excites me because while it is a small move, but the finance minister actually read it out from an Indian-made tablet, I'm told. The Honorable Finance Minister stated that India's fight against COVID-19 continues into 21, and at this moment in history when the political, economic and strategic relations in the post-COVID world are changing, it is a dawn of a new era, one in which India is well poised to be truly the land of promise and hope. She spoke about 6 pillars of the union budget, and I'm sure the eminent panelists will talk about it. She spoke about health and well-being, physical and financial capital and infrastructure, inclusive development for the aspirational India, the reinvigorating the human capital of India, innovation and research and development, and minimum government and maximum governance. This budget has been hailed as the most crucial budget in India in recent years, and the Union Budget 2021-22 has come in the backdrop of the largest ever GDP contraction that India has suffered post-independence. I guess even pre-independence, we wouldn't have had that kind of a contraction as what we had, essentially led by the COVID-19 pandemic. As I said earlier, it was a significant departure from tradition where the budget was not printed and was only made available in the digital form. So even my co-panelists here, when they had to read the budget, they had to get the digital copy to be able to look at it. The budget focused on higher spending. Healthcare expenditure was 35,000 crore purely on COVID-19 vaccine, the development and the infrastructure development, and public sector bank privatization. But ironically, the expert speculation seemed to have turned true, as the Honorable Finance Minister's first budget of the decade didn't have much hype for the common man. Not like my co-panelists, but people like me, there was not much hype in that. The co-panelists still got a lot out of it, and they will talk about it. Significant announcements included a slew of hikes in custom duty to benefit Make in India, proposal to divest two more PSBs and a general insurance company, the IPO of LIC. The banks were not named, and there are a lot of speculations as to what those banks might be. But that has created an environment to which even the stock market has reacted, and even today continues to react very favorably. The Honorable Finance Minister, in a speech, announced a push to the textile industry, a new cess on agricultural development. And I must admit, when I heard about that cess on agricultural development and 2.5 per liter on petrol and 4 rupees per liter on diesel, also 100% cess on alcohol, I must admit I was very worried as to what it will do to inflation and what it will do. It only came out in the fine print, and that is the new way where the good things that are there were not spoken about openly. It came out in the fine print that some other levies would be reduced and the net impact on the consumer would be none. The Insurance Act amendment, which proposes to increase the FDI limit from 49% to 74%, with some safeguards of management, etc. And as I spoke about, the LIC IPO will be introduced in 2021. In significant changes to the taxation process, the FM announced the scrapping of income tax return for senior citizens having pension and interest income only, new rules for removal of double taxation for NRIs, and a reduction in the time period of tax assessment, among other measures. Startups, a community that I'm very closely associated with, having personal investments in more than 70 startups. The startups got an extension in their tax holiday for an additional year. The FM also announced that the advanced tax liability on dividend income shall arrive only after the declaration of dividend income, and you did not have to anymore estimate. The FM spoke about some aspects of GST, about the fact that the collections in the last few months have been the highest ever. And the deep analytics and AI have been deployed to identify tax evaders and fake billers, launching special drives against them. That, to me personally, was very heartening to hear on the utilization of technology for the common good that the FM is aiming to use within the country. The FM assured the House that every possible measure shall be taken to smoothen the GST further and remove anomalies as the inverted duty structure. As I said earlier, the Nifty and the Sensex have given a big thumbs up to this budget, and the market response shows the optimism. The budget may not have brought cheer to the Aam Aadmi, but those who are looking at India deeply understand the impact this budget will have long term on us. COVID has impacted our day-to-day life a lot, and now this budget will hopefully reverse some of the backward trends and bring India back to growth. To give you various nuances of what this budget is, I hand you over back to Aseem as the moderator of the wonderful panel that he has. Thank you, Aseem, and thank you for giving me an opportunity to give some opening remarks. You're on mute.
Thank you, Ramanji. I think the administrator took a little while on this, and you are always a source of strength and inspiration, and personally for me, and you've been very charitable in your outlook. Well, the great late Palkiwala said, a fiscal policy is to a nation what a stable family life is to an individual. And the budget, he also said, the budget represents a silent, unheralded revolution in economic policy and fiscal thinking, the monumental task of redesigning India has begun. This is what Palkhiwala was attributing to his famous budget speeches at Talkatora Indoor Stadium in Delhi, conducted by one of the leading newspapers at that particular point in time. And this was the reference he made to a budget which was presented in mid-80s. And why this quote is special on two counts. One, this pretty much resonates what has been the approach which has been presented to the Indian Parliament by a very confident finance minister on 1st of February. And secondly, on a personal note, I don't know whether my family remembers me or remembers this or not. I was in my shorts and my father took me from the school to attend the Palkhiwala speech of this particular year. So this is the Kal Chakra of time what Palkhiwala did said in his famous speech. Now, rebooting India and impact on Indo-Bilateral Economic Ties, and what is that this budget brings? Well, we've had a new regime in United States. Not very many would be aware of some statistical finding that India was among the top 3 best performing markets during the Trump administration, with Brazil, New Zealand, and India in those top 3. If I were to look at the percentage change in terms of the trade, followed by Taiwan. So these were the top 4 economies which perhaps may have just fortuitously benefited, or maybe the policy during the Trump administration was such. Now, as things stands, exports to US account for about 15 to 17% of India's merchandise. And if you talk of imports, US is at 5th place. Now, this does suggest the enormous potential which is still there. And we are extremely glad that in today's session, we will hear the thought process of Mr. Matt Ingri a little later, and that request also came from our chief guest, Mr. Vashne, who was very keen to be present at that particular point in time. But then there are some thorny issues. I will not iterate them at this point in time, but the key from a tax perspective, as I call, is the digital dogfight with the USTR 301 initiative, and we'll talk about this a little later. But for the moment, let me take this opportunity to present Mr. Sachin Vasudeva, who's senior partner at SCV Co. I'm very fond of him in his capacity as bringing sanity to the boardrooms. I've personally experienced being as an independent director of an insurance company, and his advice is not only thought through, but brings a high level of maturity. And I think he's one of the foremost experts in terms of bringing the corporate governance and broader macro picture on board. In fact, incidentally, today we had the monetary policy announcements also made by the governor, which I think Aditi should take it up. So without much ado, ladies and gentlemen, friends and seniors, I present Mr. Sanjay Vasudeva. Sanjay, you know we have a very packed schedule, and let's adhere to the time. And for your great overview, which you do every year, I think everybody is waiting to hear your thoughts.
Thank you so much, Seem. I hope I'm audible. Am I audible?
Yes, sir, you are audible.
Okay, so good afternoon to all the panelists, and Mr. Raman Roy, thank you very much for the opening remarks. Sachin, Mr. Vashne in absentia, Mr. Matt and Aditi. And good afternoon to all the participants. Greetings from me personally and from the firm, and thank you very much for joining. I can see there are more than 130 participants, and we are very thankful to the chamber for giving us this opportunity to work together for this annual event. And as Asim has outlined and Mr. Roy has set the tone, I'll just share some of my thoughts. Mr. Roy actually covered a lot of things which I was hoping to address, but I will Asim confine within the time which you have provided. So So this budget has been presented in the backdrop of a severe pandemic, which is coupled with the economic contraction not seen for the last 40 years. It focuses on increased expenditure to push growth through a trickle-down effect. So, in fact, that's what everybody has been saying. That's what has been the votaries, have been saying, that you need to push expenditure more and more. Government has to do the heavy lifting, and the budget actually goes about to say that. And the budget speech makes some important announcements, and Mr. Raman Roy alluded to that. And in the path towards making India a $5 trillion economy, with the renewed focus in the spirit of Atmanirbhar Bharat, which was introduced as a term, as a concept, as a philosophy in May 2020. And interestingly, it acknowledges for the first time, at least as I recall, that manufacturing has to grow at double digits in the future to actually get India to a $5 trillion economy. So there is an acknowledgement from the government on manufacturing being because we've always had a focus on services. We've always perhaps felt that there are others like China who was always pushing ahead with manufacturing, but this perhaps change, this pandemic and this whole geopolitical situation has given an opportunity for us to now assert ourselves as a country as we move forward to make manufacturing the base. The budget is based on the 6 pillars, as Mr. Raman Roy also alluded to. I'll not repeat them, but I will just share and confine my thoughts to 5 aspects. And these are not the only important aspects. I thought these are just 5 aspects I'll just dwell upon, just to set the tone and to perhaps share that this is a continuum of the thought process which had started in the last budget also. So the first comes out of health and well-being, and as we all know, and there are experts who always been clamoring for more spending on health infrastructure. In fact, India, as you know, is one of the lowest spends on health as a percentage of GDP. It could range between 2 or 3%, and whereas US, for instance, spends 17%. Advanced countries are into double digit. So a whopping increase of 137% on health expenditure, which is 2,23,000 crores from about 94,000 crores in the previous year is a huge increase. And it does cover 64,000 for health infrastructure, both primary, tertiary care, and again provides for 35,000 crores on the COVID vaccine. So I think that's a really major step, a step in the right direction on the expected lines. And again, it's felt that if this kind of an incremental growth takes place, you will have a spend which is close to what most developing and developed countries have, and it goes into building human capital and accelerates the growth of the country. The other aspect, the big ticket one, is infrastructure. Now there is a talk, or the Honorable FM has talked about setting up a development financial institution. Most developing countries, in fact, some of the developed ones also have such financial institutions, and India is no stranger to that. We've had IFCI, which was set up as long back as in 1948. We had ICICI and IDBI, which incidentally got converted to banks. So this is a renewed push towards infrastructure, because again, my sense is the government does recognize that now is the right time to really push forth on infrastructure, which will propel the economy into really growth. So this comes with a budgetary allocation of 20,000 crores as the capital, and the lending which is proposed in the next 5 years is 5 lakh crores. So it's a huge allocation, and it's a big policy statement. There's again increased capital expenditure, about 5.5 lakh crores on which has been asset monetization, continued focus on metro rail expansion, newer infrastructure on metro, metro light, metro new, and again focus on buses. 20,000 buses I did read that they wanted to source. So again, a huge push on infrastructure, which again is very, very positive. Uh, a renewed focus on stress asset resolution, and there has been a talk on bad bank. So this is where the budget actually talks about setting up an asset reconstruction company, an asset management company. People may ask what is new from what we already have 29 such asset reconstruction company, but I think it's the capital which is going to come in and is going to be focused. It's also going to alleviate a lot of stress which has arisen on account of COVID. PSB, public sector banks are carrying a huge amount of loans which could turn bad because of COVID. So this will help perhaps at the central, not only in getting these loans out, or also getting better pricing for these loans. So I think great idea. Again, implementation is going to be the key because we perhaps have not succeeded earlier. The next big ticket announcement is on disinvestment and privatization. So disinvestment, we know last year we provided the budget provided for 2 lakh crores. This year they've scaled it down to 1,75,000 crores, but they really want to make it happen. Mr. Raman Roy also mentioned about the LIC IPO. Yes, that is a big ticket one. There are others like BML, Air India perhaps could be another one of the block. And also privatization. This is something really new which we've not heard from the government, which is held on to the public sector undertakings as crown jewels. And this is something which perhaps indicates a shift in approach. So 2 PSBs and 1 general insurance company to be privatized. And again, this would reduce the scope for government to fund PSBs as well as insurance companies. So this is again a great announcement. Coming to another spectrum totally on the startup space, Mr. Raman Roy did mention about digitization, and he acknowledged the fact about the budget being digital. But yes, the 1% company, I think again, to push startups and entrepreneurship, I think that's a great flexibility which has been given in terms of increasing the threshold. More and more people can set up those companies. There's incentive for NRIs, there's incentive for residents also, 120 days. So this could give a big boost in the tier 2, 3, 4 cities. So these are some of the big ticket, announcements. I know I've not covered everything, but yes, this goes in the direction of really pushing for growth. Some of the concerns which we need to be aware of, that obviously there's an acknowledgement that the fiscal deficit is now at 9.6%, 9.5%, and this is obviously on account of the pandemic, greater spending, slower growth, tax collections were low, and 6.5% is budgeted for next year, and we reach 4.5% by 25-26. So the fiscal discipline which we had set in place is not to be seen till at least post 25-26, and which means it's a lot dependent on disinvestments, a lot dependent on the push which happens from the economy and tax collections. In fact, maybe Sachin can also share what is his view on tax collection. They've taken about 13 to 14% growth on an annualized basis on tax collections, and I think a GDP growth about 6% there, and whether that is feasible, and maybe Aditi can come in if the numbers really tie up. Then on the ARC and disinvestment, I think ARC, as I mentioned, is a great concept, but in the past we've had challenges. So how smoothly it can function, how quickly it can function, and how quickly it can alleviate the stress is going to be important. Disinvestment was dismal in the last year. You could say that because of the pandemic, but then we've got to make it happen. 1,75,000 crores. Otherwise, the revenue shortfall and the fiscal deficit stares us in face. There is hike in custom duties in line with Atmanirbhar Bharat. Yes, it is going to be, it's going to boost domestic manufacturing, but is it in line with our relations overseas? Is it in line with the commitments which we made to WTO on the tariff? The keeping tariff at a certain level is something which we need to see. Uh, and I think the devil is really going to be implementation. I think implementation is something which really needs to happen at the ground level to really translate this into reality. So the FM and the government has laid before us a path, has shown us a vision for the next maybe 5 years or the decade. There are a lot of good things in the budget. Yes, some things have been omitted. The common man, maybe not enough for no major announcement. What the farmers were expecting, but yes, it does go in the direction, and if implemented properly, can really go into giving a push to growth. And again, as Aseem, you mentioned about the Indo-US ties. You talked about export and imports. I think both have been falling as far as India is concerned. It could also provide an opportunity for a growth in exports, because if you have manufacturing, you will definitely have an opportunity to export. The disinvestment, the increase in FDI limit for insurance provides opportunity to companies from the US to look at India. Startup space, India is today the fourth largest, perhaps as far as startups are concerned. So a lot of opportunities for Indo-US, and I think this is the right time. New decade, new opportunity, new government in the US, a new budget, a new vision, and to really reset the ties for India. I won't spend much time talking about tax proposal, because, as you know, Sachin is the expert, and I think those are my thoughts. I'm fairly bullish on, and I feel that yes, it has provided the right, I would say, inspiration and motivation to all of us to look at this future with a more passion and a great positivity. So hopefully, if we walk the talk, we would be able to really move forward. So thank you once again, Aseem, and all the other board members for giving me this opportunity to share my thoughts. And I'd love to hear from Sachin and Aditi on Sachin on tax, and Aditi, as always, on how the numbers really add up, and are we missing out anything on the expenditure or the revenue front. Thank you very much, Aseem. Thank you. Over to you.
Thank you, Sanjay, for this very lucid narrative. And when you said walk the talk, it reminded me of our great late Atal Bihari Vajpayee Sahab. Uh, and on Indo-US relationship, he said, and I quote, "India is today a nation on the move. The momentum for progress that has started gathering speed, nowhere is this more pronounced than in industries that will shape global economic relationships of the future." On startups, we have our guru, our chair, Mr. Roy, and even the dispensation made by Ministry of Corporate Affairs during this week of allowing startups to merge and one person's companies to merge in the NCLT proceedings, I think will usher a great era of quick restructuring and realignment in that particular space. And as far as tax is concerned, well, before I present Sachin to you, no deliberation is complete without flavor, which is the cricket. I really don't know what the scoreboard did tick today, but if I always have referred to as Mr. Rahul Dravid in third person to Mr. Varshney, which I will do when he joins at 5:15, hopefully quickly wrapping up his North Block meetings. Well, my Chiteshwar Pujara is no better than Sachin. I mean, not only he's a able co-chair and therefore he doesn't need any introduction. He's very clinical and has kept me honest and on my toes. In fact, made me go through 45 provisions of the direct tax proposals again today at 12 noon, so that we don't miss out anything. So this is his allegiance along with his wonderful team. So without much ado, Sachin, about 25 minutes and just help in also looking at the challenges. Our tax GDP ratio 3.7 in the first half of the current financial year. I mean, looking at the locked up tax revenue, which everybody felt was only in the years of tax terrorism. But if you look at the numbers, they do suggest the fact that the unrealized tax revenue in total direct tax collections have gone up from 64% in 13-14 to about 71% in 18-19. So, and we have a lot of policy prescription in this particular budget. But just one thought for you. Are we getting into the bureaucracy age back again with the abolishment of advanced ruling authority, which in any case wasn't really doing great, I must frankly admit, and doing away with settlement commission, which saw so much of legislative changes as if government was not sure of what to do, but bringing it back within the revenue space and whatever little independence associated was. Are we going back to the age of a super taxman also is something I leave my thoughts to you. But with this, Sachin, about 25 minutes should be sufficient. Yeah, over to you.
Thank you, Asim, for the kind words. I will try my best to bat in the manner as in which you have suggested, and please condone or pardon if I'm not able to do so. So, good evening to all, and thank you for joining in today. In the next half an hour or so, I'll take you through the important tax proposals contained in the Budget 2021. A lot of effort has been put in by our team to put this PPT together, and without their help, this would not have been possible. So a big thank you to my team. I would like to commence my deliberation by quoting the Honorable FM, and I quote, this is from Part B of her speech. In this scenario, our tax system has to be transparent, efficient, and should promote investments and employment in our country. At the same time, it should put minimum burden on our taxpayers. Now, with utmost respect and humility, the proposed tax changes do not purport to achieve the stated objectives. There are many changes which unsettle the existing settled law on the subject, and the trend to reverse decisions which are in favor of the taxpayer is actually disturbing. So let's now go through the changes in much more detail. As far as tax rates are concerned, there is no change across the board. In December, a scheme was announced whereby the LTA component or the LTC component could be exchanged for cash, and if the cash is used for purchase of goods or services attracting 12% or more GST and 3 times the amount of entitlement is spent, then a deduction could be claimed. So, to give legislative recognition to the scheme, this amendment in the law has been proposed. A relaxation for senior citizens, pensioners from filing return of income. This is applicable if the individual is resident in India, plus 75 years old, receives pension and interest from the same bank. If at all you have to provide a relief, then why this condition that the interest income should be from the same bank? This is something which is not understandable. He has to furnish a declaration to the specified bank. The bank will do all bit in terms of deduction of tax, depositing of tax, and thereafter the individual need not file his return of income. Any contribution in excess of 2.5 lakh made in a year to the Provident Fund, the interest thereon is now proposed to be taxed. Similarly, for ULIPs, the premium paid, which is in excess of 2.5 lakh in a year, then the majority proceeds are sought to be taxed by excluding them from 1010D, and the taxability will now happen by way of capital gains. So the money received in excess of the premium paid is going to be taxed as capital gain, and no indexation is going to be provided. On the corporate taxation front, as was mentioned, that there is a huge push towards disinvestment and monetization. So to enable a framework for all those disinvestment and monetization schemes, the amendment in section 219 AA, which talks of a tax neutral demerger, and section 72 capital A, which allows the carry forward and set off or brought forward losses and unabsorbed depreciation. So changes in these respective sections have been made to facilitate the disinvestment of public sector companies. The provisions of minimum alternate tax have been rationalized. So if there are any transfer pricing adjustments resulting from the APA or secondary adjustments, which result in the increase in the past year's book profit, then the AO, the assessing officer, has been empowered to recompute such MAT by resorting to section 154. The second amendment is a consequential amendment on account of dividend being made taxable. So in case of a foreign company, dividend income has to be excluded and expenses in relation to earning of such income to be added back to book profit, where such income is taxed at a lower than MAT rate due to the DTA. So similar provisions are already in place for capital gains on securities, interest, royalty, and FTS. So that whole scheme has been now extended to the dividend income stream as well. Amendment is proposed in section 36 and 43B. Now this is with regard to the employee contribution in respect of PF and ESI, which is collected by the employer and which is thereafter deposited with the appropriate authorities. Up till now, the amounts so collected, even if deposited after the due date mentioned in the respective statute, which is 15th of the next month, but deposited by filing of return of income by the employer, several decisions of the High Court, including the Supreme Court, held that the employer could get this deduction. However, now even a delay by a day would make the employee contribution taxable as income in the hands of the employer, and no deduction would be allowed of such contribution. There was a raging controversy as far as slump sale is concerned. So the taxability of slump sale is governed by section 50 capital B, B as in Bravo. Slump sale is defined as transfer of one or more undertakings as a result of sale for lump sum consideration without value being assigned to individual assets and liabilities. So the whole controversy was whether this term sale includes any exchange, or is it restricted or limited to a sale whereby in return you get money. A few courts had taken this view that if in exchange of an undertaking what is received are shares of that company, the transaction is outside the purview of slump sale. So to correct or to overrule those decisions, the definition of slump sale is now proposed to be changed by deleting the words as a result of sale. So now a slump sale would mean transfer of one or more undertaking by any means for lump sum consideration. So even a slump exchange now gets taxable as a slump sale. Section 45(4) in the existing scheme of things was a section which provided that any transfer of a capital asset on dissolution of a firm is subject to capital gain tax in the hands of the firm. Now, there were a plethora of judgments which provided that this section would not be applicable on retirement of a partner. So the term otherwise, which is used in section 45(4) as it stands today, would not include a case of a retirement of a partner. So the amendment firstly removes the word otherwise and replaces it by reconstitution. So 45(4) would now get attracted on transfer of a capital asset on dissolution or reconstitution. Reconstitution is a very, very wide term and would include almost all facets of reorganization between a partnership. Another issue which was relevant was that the accretion to the partner's capital by way of goodwill or a revaluation of assets was permitted, which led to nil or negligible tax in the hand of the partner if any amount was received in excess of his capital balance, because there are judgments various courts had held that any amount received by the partner in excess of his capital balance is also capital receipt and not subject to tax. So to set right this aspect, the section 45(4) and has been amended and 45(4)(a) has been inserted. 45(4)(a) now seeks to tax the amount received by a partner over and above his capital balance as a capital gain in the hands of the firm. So while the partner is receiving the amount in excess of his capital balance, but the taxability is deemed to be in the hands of the firm as a capital gain. And for this purpose, the capital balance would not include any accretion on account of revaluation or goodwill. Let me quickly take a very, very small example to drive home this point. So assuming there is a partnership firm in which Mr. A is a partner, his capital balance is of 100. The firm has land, the cost of which is 60. The fair market value of the land could either be 100 or 200. So if the firm were to transfer the land to Mr. A on dissolution or reconstitution of the firm, the first leg of capital gain will be on the firm, whereby the firm would pay tax on the difference between the fair market value and the cost. Simple. So if the fair market value is 100, it will be 100 minus 60, 200, and 200 minus 60. This is, of course, subject to indexation. When it comes to the partner, if his balance is 100, he gets 100, there is no tax. But if his balance is 100 and he gets 200, then that differential of 100 would now get taxed as capital gain over and above that 40 or 140, which is already been paid by the firm, again as capital gain in the hands of the firm. Extending this example, if the 100 of the partner comprises of 20 of goodwill, which has been credited to his account, and 80 is his normal capital, then the computation of capital gain for the purposes of section 45(4)(a) would be done with reference to 80 and not 100. As far as charitable trusts are concerned, every year there are changes. This year is no exception. So there are 4 changes which are proposed to be made as far as trusts are concerned. Voluntary contribution made with a specific direction that will form part of corpus to be invested in modes under 11.5. So the government wants that this should be kept invested and not spent. Any application of the corpus in the year, if it is spent, will not be treated as accumulation, will not be treated as application, pardon me, but it will be considered as application of income in the year in which it is deposited back to corpus. So for example, if in a particular year your income is 100, you spend 140, 40 is out of your corpus, that 40 will not be treated as application. In the next year, your income is again 100, and you deposit that 40 back in the fixed deposit as part of the corpus. In the next year, that 40 which is deposited back to the corpus will be allowed as an application. Application from loan and borrowings to be considered as application only the year of repayment, meaning thereby if you have taken a loan and you spend that loan, expenditure is incurred in that year, it shall not be treated as application. And no deduction of excess application of any preceding year to be allowed while computing the income required to be applied or accumulated. These are certain changes which are applicable for all taxpayers. With effect from 1/4/2019, a safe harbor provision was introduced in section 43CA and 56(2)(10). So these 2 sections deal with the case where the sale consideration is lower than the stamp duty value of the immovable property, and the differential is then brought to tax. So 5% safe harbor was introduced with effect from 1/4/2019, which was increased to 10% by Finance Act 2020, which is now proposed to be increased to 20%. However, certain conditions that this would apply only to transfer of residential unit between 12th November 2020 to 30th June 21. The transfer is by way of first-time allotment of unit to the buyer, and the consideration does not exceed 2 crores. There is considerable relaxation for sovereign wealth fund and pension funds. So the investment made in infrastructure sector by the sovereign wealth funds and pension funds, the income which is derived by way of dividend, interest, or long-term capital gain is 100% exempt under section 1023 FE. Now there are many conditions for the wealth fund and pension funds to claim this exemption. Now those conditions are now proposed to be relaxed and made more flexible. That is the only change as far as this section is concerned. Tax incentives are proposed to be provided to the International Financial Services Center in state of Gujarat, known as the Gift City. And these concessions are, so tax incentive for relocating foreign funds in IFSC, tax holiday on capital gains for aircraft leasing companies, tax exemption on aircraft lease rentals paid to foreign lessors, and tax exemption to investment divisions of foreign banks which are located in IFSC. The withholding tax on payments made to FIIs has been, will undergo change. So at present, the TDS on payment of income from securities FII is at 20%. Now what is proposed is to provide lower of 20% or DTA rate. So the history behind this change is that under section 196D, there is a fixed rate of TDS, and the Supreme Court in another section which is 194E had held that where the section provides a fixed rate, the DTA rate cannot be imported into that section. So to provide the benefit of the DTA rate, section 196D is proposed to be amended. Surprisingly, there are other sections also where a fixed rate of TDS for income which accrues to non-residents is there in the Act, but those sections like 194E, 196A, 196B, and 196C, there is no change. The provisions related to the limit for tax audit under 44AB are proposed to be enhanced from 5 crores to 10 crores. The conditions are that the aggregate of all receipts in cash during the previous year does not exceed 5% of such receipts, and aggregate of all payments in cash during the previous year do not exceed 5% of such payment. Welcome change. There are not many changes for which I could say welcome change, but this is certainly one of them because this would reduce the compliance burden. Under the existing provision of 234C, which is interest for deferment of advance tax, certain items of income are excluded for payment of interest. So when you estimate your income for the full year, you don't know how much amount of dividend you are going to get during the year. So therefore, dividend has also been included for the purposes of exclusion of estimation of advance tax for the purpose of computation of interest under 234C. In order to provide an early tax certainty to small and medium taxpayers, it's proposed to introduce a new scheme for preventing new disputes and settling the issue at an initial stage. The new scheme is proposed to be incorporated in a new section 245MA and has the following features. So, a taxpayer is eligible where the dispute, where the return income is rupees 50 lakh or less, and the aggregate amount of variation proposed in the order is 10 lakh or less. There would be other conditions also which are proposed to be prescribed in due course of time. It would not be eligible if there has been a detention or a prosecution of the taxpayer or he's been convicted under various laws. The existing provisions of section 147 to 149, which deal with reassessment of income, are proposed to be substituted. So this is what I said, unsettling the settled position, which is bound to only increase litigation and not reduce litigation. So insertion of new section 147 to assess or reassess income that has escaped assessment. A new section 148A to conduct an inquiry before issuance of a notice. Substitution of existing provision of 148 for issuance of notice, and amendment in 149 for time limit for issuance of notice. And the existing provisions of section 153A, which deals with the assessment in case of search cases, is now proposed to be subsumed in this new scheme of section 147 to 149. What does 148A say? Now 148A, as I mentioned, is conducting an inquiry by providing an opportunity before issuance of a notice under 148. So the AO to conduct inquiry to suggest that income chargeable to tax has escaped assessment. So there's a totally new concept. Up till now, we had this terminology, reason to believe, which we had very well understood, the courts had explained what is reason to believe and how that has to be applied to the facts of each case. Now we have entirely new scheme which is suggests that income chargeable to tax has escaped assessment. And what is this suggestion? We'll come to that in the subsequent slides. So the AO will conduct an inquiry. He will provide an opportunity of being heard to the taxpayer by serving a show cause notice. After consideration of the reply of the taxpayer, the AO will pass an order as to whether or not it is a fit case to issue a notice under 148. There are timelines by which the reply has to be furnished and the order which has to be passed. 148A will not apply in case of search, seizure, or other requisition cases. The AO to serve notice under 148 along with a copy of the order passed under 148A, and assessee to furnish his return of income or the income of any other person in respect of which he is assessable within the time specified in the notice. Now, what is that information which would suggest that income chargeable to tax has escaped assessment? Information flagged in accordance with the risk management strategy formulated by the board from time to time. So it's made more of a mechanical process now. So the application of mind, which was a very important feature of the reason to believe era, now seems to be done away with. Then a final objection raised by the CAG of India that the assessment has not been made in accordance with the provisions of the Act would also be one of the reasons which suggests that income chargeable to tax has escaped assessment. For search, survey, or requisition cases initiated after 1/4/2021, it is deemed that the AO has information which suggests that the income chargeable to tax has escaped assessment for 3 assessment years immediately preceding the relevant year in which the search, survey, or requisition is initiated, made, or conducted. So the concept of block assessment, as I mentioned, is proposed to be done away with. The time limit for issuance of notice under 149 is proposed to be altered. So up till now, there were 3 limits, 4 years, 6 years, and 16 years. That is now proposed to be made into 2 buckets of 3 years, but not more than 10 years. And in the second bucket, what is going to be covered is where the income which has escaped assessment amounts to 50 lakh or more. With the massive technological upgrade in the department, where the processes under the Act are moving towards becoming faceless and jurisdictionless, the time taken to conduct and complete such processes has greatly reduced. Hence, amendments for rationalizing the time limits under the Act. So time limit for belated or revised return to be reduced by 3 months. So for example, for assessment year 21-22, meaning year ended March 21, you file your return by October 21. You can revise it by 31st December 2021 and not by 31st March 2022. Likewise, the time limit for completion of assessment is proposed to be reduced from 12 months to 9 months. So
we need to just quickly move on, and also I must acknowledge and express my gratitude to Kamlesh Saab for being there. I'm extremely grateful. He's joined. Sachin, let's hurry up.
Yeah, sure, quickly. So ITAT proceedings are proposed to be made faceless. Okay, I'll just spend a few minutes on the concept of equalization levy. So this was introduced by Finance Act 2020 to tax e-commerce supply or services. And e-commerce supply or services means an online sale of goods owned by e-commerce, an online provision of services, an online sale of goods or the provision of services are both facilitated by the e-commerce operator. An e-commerce operator means a non-resident who owns, operates, or manages digital or electronic facility or platform for online sale of goods. Now, these terms of online sale of goods, what were these? They are now proposed by to enlarge the scope by including acceptance of offer for sale or placing of a purchase order, acceptance of a purchase order, supply of goods or provision of services, or payment of consideration. So out of these five, if any of them happen through a digital means, it would mean that the non-resident would get covered in the scope of equalization levy. So, Asim, I would request that this aspect may be discussed with Mr. Varshney, because this would probably mean that almost all import transactions might get covered under the equalization levy concept.
Yeah, and from as we did discuss a little earlier, from a US standpoint, considering the USTR report, this is one of those thorny issues. But having said so, I mean, we all understand, even the Commerce Ministry has suggested that India disagrees. So, of course, we will have the last word for the day from Mr. Varshney as well as from Mr. Matt on this, how this digital dogfight will move forward. Yeah.
So this particular proposed change seems to be a retrograde step whereby no depreciation on goodwill is proposed to be allowed. Importantly, a definition of liable to tax is now proposed to be inserted. And here again, I would request if Varshney Saab could explain that whether this whole debate of Indian citizens who are in UAE, would they now be considered to be liable to tax or no, pursuant to this amendment?
Yeah. In fact, looks like one of those happy insertions of definitions, unlike few of them which we've had otherwise in Section 9 by virtue of enabling insertion of Section 90 subsection 3 with regard to terms for the purposes of tax treaty. Yeah.
194Q reverse of 206 C1H, whereby the buyer is now supposed to deduct tax on purchase of goods. A new section to catch hold of non-filers of returns of income by proposing that a higher rate of TDS would be applicable on them. Very, very quickly.
I think, Sachin, let's wrap up,
Yeah,
because...
Is this? Okay, sure.
Yeah.
Okay, see, I had no choice. You had referred to me as Chiteshwar Pujara, and he likes to bat on. So,
yeah, knowing very well that Rahul Dravid, we have Mr. Reliable, Mr. Varshney, as we affectionately call him in this chamber, being right up there. And for Aditi also, today was a day coinciding with the accommodative stand on the policy by the RBI governor. So, yeah, if you just close it in next 1 minute, that will
yeah,
be
I will surely, absolutely. So, new explanation in Section 7 of the GST Act to overrule the decision of the Supreme Court, whereby the supply by a club to its members was not taxable, is now proposed to be made taxable. For claiming input tax credit, you could only now do so if the supplier has furnished the GSTR 1 and the same is reflected in your GSTR 2A. The GST audit is proposed to be done away with and to be replaced by a self-certified reconciliation statement. and if any interest has to be paid in terms of your liability, that has to be computed on the net cash liability, meaning if your liability is 1 lakh, there's an ITC of 40, your net cash liability is 60,000, so you pay interest on 60 and not on 1 lakh.
Okay, Sachin,
Thank you.
I think I will just have to request you. So Shikha, in the interest of time, can you just speak your 5 minutes on this? And ladies and gentlemen, friends, as we move on and building up on our Indo-US theme, and India wants, as the entire underlying theme of this budget has been Atmanirbhar Bharat, which is self-reliant India. And on trade and business initiatives, you have the PLI and RODTEP scheme. Shikha, by the word, you have just 5 minutes to convince that India will become Atmanirbhar. But you just have 5 minutes to convince.
Sure, Aseem. Am I able to share the slides with you?
Yeah, you can quickly share. On a related party note, friends, Shikha heads the trade tax policy at our firm. Shikha, very quickly, just flip the slides and 5 minutes.
Sure. Is it visible to everybody now?
Yeah, great.
Yeah, sure. Basically, today I'll be covering the push that the central government has been giving to the production and exports in India, which has been counterintuitively opposed. Basically, the export incentives that Indian government has been giving to push its exports has been challenged by US and America in March 2018, which we before WTO panel, and to our great regret, we had lost that. We could not claim the exemption that developing nations get from the export subsidies that they give for their production and exports. In a bona fide attempt, the Indian government has launched the RODTEP scheme, replacing the erstwhile contentious schemes which were challenged by US, namely mercantile export incentive schemes, shortly called as MEIS. And these RODTP scheme has been coupled with PLI scheme, which is also to enhance the production capacity in India and to push for them a little further. So I'll be discussing about both these schemes in these slides. So these are the contents. We'll discuss about the eligibility and the procedural requirement, and for both the schemes, and how it affects Indo-US bilateral trade relationship, and how it also gives an opportunity to build the synergies between the two nations, which are actually democratically aligned and have similar socio-economic interests aligned with each other. So basically, RODTP scheme has been made effective from January 1st, and it's a broader scheme than MEIS basically, and it doesn't link the export incentives directly to the export performance. However, it does give incentives in terms of refunds of duties, embedded duties and taxes, which are there in the products and which were not refundable and which were a cost to the exporters earlier. This particular scheme is broader in aspect, and has been, so the background that I've already given regarding the WTO case that India had lost. This slide discusses the need of this particular scheme, and I've already covered, so I'll skip by these slides. These were the schemes which were challenged before the WTO dispute panel, and one of these schemes is MEIS, Merchandise Exports from India scheme. These are the features for RODTEP, which is replacing this MEIS scheme, wherein the refund is given of mandi tax, VAT, coal cess, central excise duties on fuel, etc. These are the state levies which were earlier a cost to the exporter. However, these are available under this scheme as a refund to the exporters. Even though this is a wider incentive for the exporters, however, the refundability of GSTs and how the advance authorization will be treated in light of this particular scheme is yet to be seen. And because there is some legislative gray areas in the GST legislation and the foreign trade policy still existing. So that has to be seen. However, in principle, the scheme is broader and gives more incentive to the exporters. So these are the eligibility criteria, which is again, I will emphasize that the eligibility criteria is really broad. It is available to all sectors. There is no particular turnover prescribed for this scheme, and you can couple it with other schemes like SEZ units and EOUs. And even the goods exported via courier through e-commerce platforms are covered under this particular scheme. So this is the comparison between the MEIS scheme and the RODTEP scheme, which was earlier, MEIS scheme, which was earlier there. MEIS was giving a direct incentive on the export performance, and this is the particular ground on which the WTO panel has held these particular schemes to be violative of WTO norms. However, RODTP is a refund of duties and taxes which are embedded in the inputs used for the production of these export goods. Again, earlier the MEIS scheme was giving.
Shikha, you just have last 1 minute.
Yeah, physical transferable scripts, and this one is an electronics form. I'll skip by all these things. The notification of the rates under this scheme is delayed, so that is again a downside of this particular scheme. Product linked incentive scheme is applicable to 13 sectors now. Earlier it was only provided to 3 sectors, and 10 more sectors were added in November 2020. And 4 to 6% of incentive is given on manufacturing. However, you have to commit a particular investment to avail this particular scheme, and you have to give a particular performance in production at production side to avail this particular scheme. So I will just skip by this. This I already discussed that there's a threshold condition for this, and the base year is 2019 to 20. It is applicable for 5 years, and this is the approval mechanism. Economic impact, obviously this will enhance production, and enhanced production will lead to more capacity building in terms of workforce and skill development and technology and allied sectors. This is the crux of this particular presentation, that this particular export benefit scheme and the production linked scheme should be seen as an opportunity for the MNCs which are looking to go out or have already moved out from China and are looking for an alternate investment destinations. India is pushing really hard through its policies and the changes that it is bringing on board with respect to transparency and ease of business, and obviously the incentives that it is giving out. So one of the US company, Visicon, has already got the approval under the PLI scheme. So that is one of the indicators that, and there are many other non-US companies and internationally having their operations which have already availed the benefit of this particular scheme. So I believe that coupled with the export schemes and the production schemes, the US companies which are production centric and want to establish a supply chain for global supplies, they can look towards India for further building the relations in terms of trade.
Thank you, Shikha. That's great, and you pretty much are giving us the hope that our chamber would continue to subserve the interest of Indo-US. I'm thankful to you, and my gratitude to Matt for the simple reason of acceding to our request of altering the schedule, because Mr. Bhatt was very keen to hear yourselves while he's also around. Thank you for your time, and thank you for your seeing you in a new avatar also. Ladies and gentlemen, it's a great privilege to introduce Mr. Matt Ingreri. On a personal note, I mean, we're from the same profession. He is a member at the New York and Washington, D.C. bars, and importantly, has a JD MA in International Relations from Boston, which is close to my heart because I'm from Kennedy School. There is a lot of India, US, our Commerce Secretary talking about that sticking points in India, US mini trade deal is fixed. India has taken a stand with regard to Google tax. I don't think we could have anybody better than you to air your views. Over to you, sir. Thank you for your time.
Okay, thank you. Great to be here, and always great to reconnect with IACC. You know, we appreciate everything you do for the relationship, and as I always point out, you know, IACC was supporting and promoting stronger ties between India and the United States long before that type of opinion was fashionable. So, you know, we are grateful for you being in it for the long haul. I'm going to step back a little bit, I think, and sort of talk about this from the 30,000 foot perspective, just because everyone else has kind of gone through the details on the budget. But, you know, obviously this is the most ambitious budget we've seen since I arrived here in 2018. And I'd note that the Sensex has responded very positively to this budget, whereas I believe it went down the last two budgets. So it's a good reminder of fortune favors the bold. But stepping back a little bit, about 2 years ago, when India's growth started flagging, we started kind of both a conceptual and sort of public diplomacy outreach for sort of 5 major structural economic reforms that we thought were necessary for reviving growth even before the pandemic, as well later on in terms of the desire to integrate more fully into Indo-Pacific supply chains and become an alternate supply chain hub to China. And you know, in keeping with Prime Minister Modi's stated goal of a $5 trillion economy, we called it 5 for 5. And obviously this is not everything that needs to get fixed or changed in a society as complex as India, but we thought it was a useful way to sort of focus and create some broad themes. So just to kind of recap what those were, this was labor law reform, financial sector reform, infrastructure modernization and expansion, land law reform, and improved regulatory certainty and transparency. You know, with this budget, I would point out, and as well as the September session of Parliament, you know, the government has now addressed, you know, directly 3 of those 5. On land, you know, this is a state issue, and there's been a lot of discussion about land banks and you know, whether those are sufficient or not kind of plays out on a state-by-state level. Which so that, you know, largely leaves in the to-do list the greater regulatory certainty and transparency. Though I think a lot of the discussion in terms of taxes actually does improve that. So, you know, obviously a lot of progress has been made. I'm not trying to say that we certainly didn't tell the Indian government what to do, but sort of more, you know, great or middling minds on our side think alike. So obviously there's a lot of excitement about this budget, but I think it's part of a process that really started to kick into gear with the pandemic last year, and we've seen an acceleration of and revitalization of economic reform since we all went into the first lockdowns last March, and kind of brings to mind former Obama Chief of Staff Rahm Emanuel's dictum that one never lets a good crisis go to waste. So, in terms of the budget itself, I think we're exceedingly excited about the financial sector reforms and kind of the focus of reform moving into kind of the what is actually a pretty complex and technical area. Given what's going on outside Delhi, I'm sure there's lots of people in the government who are quite happy to be focusing on a technical and complex area rather than something that gets people out in the street in a very emotional way. But I think one needs to take all this stuff together under that umbrella in terms of the lack of major new taxes that were announced, and then following 2019's lowering of the corporate tax rate, and of course the 2017 reform that created the GST, along with the creation of a bad bank. This is something that people have advocated for a very long time. The issue with non-performing assets has unfortunately been perennial, and been a weight on growth for quite a long time. I think even predating the current slowdown in growth that started before COVID in late 2018. And you saw that I think it also leads into issues with long-term credit, which several of the provisions in the budget speech are directly addressed at, either in terms of creating the new Development Finance Corporation, as well as several investment trusts. And I would kind of put liberalization of the insurance sector in there as well. And so, when you combine that with what happened with labor reform in September, you have a much greater opportunity to grow small businesses into medium-sized businesses. And in terms of, how this is any business in the United States, those medium businesses have really been kind of the missing link in terms of forging partnerships between U.S. multinationals and potential Indian suppliers, and increasing India's role in those regional supply chains. So being able to grow without statutory limits and the massive regulatory burden suddenly falling upon you before you can even hit medium size, combined with greater tax certainty and increased ability to get capital on a long-term basis, with not only for medium-sized businesses, but even several domestic larger businesses. The largest Indian businesses obviously can go to foreign capital markets, but most companies can't. So this is all very exciting stuff. On the infrastructure build out, we've been excited about this, frankly, since last year when the National Infrastructure Pipeline was unveiled. We were talking about a $1.4, $1.5 trillion infrastructure build out. The money for that has always been a bit of a question mark. The openness to foreign investment and private investment in infrastructure was always a plus, but I think there was a concern about a possible over-reliance or overly optimistic calculations of how much private investment could be utilized under the NIP. So a significant expansion of the government revenue going into in the infrastructure sector. I think it's about between 35 and 37% in this budget, combined with the creation of the DFC and those financial reforms, which are largely seen as a prerequisite for private investment in infrastructure, since these are 30, 40-year deals. That really supercharges this effort that kind of began about a year ago on the current 5-year plan. So again, there's lots of stuff in the budget to be excited about, but I think it's also good to stress that these are all kind of streams coming together that have been in play for a while now. Looking forward, investment incentives are nice. Export incentives are a potential tool, though obviously, as you saw, it's important to stay within the confines of the WTO rules. But what really makes the difference is the overall business environment, and neither incentives really can't compensate if you don't have that right. And so what we're seeing is some real bold actions, reaching their apex with this budget. Well, and hopefully moving forward, both in implementation and in expansion, to really get that overall business environment in place. When I first got here back in mid-2018, if you talked about India becoming a bigger player in regional and global supply chains and being an alternative to China, people tended to look like you had proposed a mission to Mars. This is only 2.5 years ago. So obviously, the Prime Minister's speech this summer, where he was talking about expanding India's role in those Indo-Pacific supply chains, was pretty seminal shift. But going back, part of the reason people were a bit incredulous is the estimate was that the costs in it to produce, manufacture, and export products from India ran roughly about 20% more than they did in China. I'm not sure, I don't think it's quite that big a difference between, say, India and Vietnam, but still significant. These structural reforms, along with things like lowering the corporate tax rate last year, they really go to the heart of why those numbers are the way they are, and that getting that number down, if not to parity, then at least to a competitive level, that's really the key here, both for promoting manufacturing, promoting exports, promoting greater integration into those supply chains that'll supercharge both of those efforts, but also in terms of reviving and supporting what fortunately has been an earlier than expected revival in economic growth following the onset of the pandemic and last year's lockdowns. So I really want to emphasize our respect for the ambition of this budget and kind of the focus of this budget on really targeting a lot of the key impasses and blockages that have long hindered India's competitiveness and ability to kind of achieve these goals, and how this is a real improvement in the approach, frankly, from some of the earlier attempts either at promoting manufacturing or exports that were kind of more, I'd say, more winner take all. And proved fairly ineffective. If you look at the numbers, manufacturing pretty much stayed where it was, and trade either stayed where it was, or vis-a-vis China, the trade deficit worsened. So I think this is really the right track, and I think we're eager to kind of expand our discussions with the government and find out, at the end of the day, this is the Indian government's economic reform, not the American government's economic reform for India. But we're eager to find ways we can kind of expand our cooperation with the Indian government and share our experiences and where there's interest, our expertise, to really help either in the implementation and ensuring the success of these reforms, or offering our perspective and views on kind of what the next steps might be. So I'll leave it at that. But I think this overall, I think this was a pretty historic week.
Thank you, Matt. This is testimony to the not only the great vision, but if I were to say a straight talk, and in fact you remind me of one of my favorites, Timothy Geithner, who transitioned to the Obama administration. And I must tell you that over the entire lockdown, if there was one memoir worth reading, was the Treasury Secretary's memoir in terms of taking through the financial crisis. And I'm sure Mr. Varshney has also gone through the same, and knowing very well that waking up till 4 a.m. on the budget day was no mean task for his erudite team. The thorny issues, Matt, would be, and not that you have to give any answer, but for the benefit of audience, the withdrawal of $5.6 billion on the trade concession under the generalized system of preferences. And from a tax point of view, I mean, the backlash which we anticipate, at least from the digital dogfight and India's result from the Google on the equalization levy, and the US not being party really to the MLI with the multilateral instrument program, and being a great spectator. I mean, I've personally been at the United Nations forums, and there's a lot of US presence there on the sidelines, either from the private sector and big enterprises. But to be able to take that commitment requires something. So I understand these are India's problem, but somewhere we are just, should we brace ourselves very high for something to that, or what?
I don't know about brace. In terms of being on the sidelines, the president was at the State Department today, and really sort of stressing diplomacy is back. So obviously, as a Foreign Service officer with the State Department, I'm heartened to be back, sitting where I've been. GSP. This has been the subject of a long-standing trade negotiation that began in the previous administration. I don't think that the new administration's had time to really make a decision on where they go from here, and so we'll have to wait and see. In both of those, the underlying issue with GSP as well as the negotiation. I would point out, the interests are the interests, and they don't really change. On these trade matters. I worked extensively on trade in the Obama administration. It wasn't like our concerns suddenly evaporated when Donald Trump became president, and the industries that had been concerned or alarmed, had suddenly didn't have problems anymore because of the president changing. So there's a certain continuity there. In terms of the 301, the report is out. I don't think there's been a decision on what the action to be taken will be. Again, I don't think I'm not 100% certain on this, but I don't think our new USTRs is confirmed. So I think we at the State Department are a little ahead of the game on the Senate confirmation process. I do remember working on the transition to the Obama administration on trade, and again, there was a gap of several months, frankly, between when we had Secretary Clinton and our team in place and when they got U.S. Trade Representative Ron Kirk, and you'd think bureaucratic fighting wise, like, oh boy, we at the State Department get to take over, but it actually is a challenge from both sides, because the world doesn't stop spinning and you have to move and make decisions, and those have to be decisions that can survive 3 months later when all the teams are in place. So the report itself, I think, was done with a lot of extensive analysis by the Commerce Department, the International Trade Commission, the Treasury Department, with input from the companies. There was formal consultations with the Indian government. I think, being familiar with the provision and the companies here, I think it's a pretty level-headed and apolitical report. What happens based on those findings, we'll have to see. I was on a call yesterday, actually, and there was someone who I guess was involved. So probably the Joint Secretary knows them, who was involved with the creation of the equalization levy either last year, and kind of conceded that it was moved rather quickly, and noted it was added to the budget, and there really wasn't a public consultation or notification period before it was enacted, and so there was a bit of a scramble last year as the companies were trying to comply, but they didn't know what the meaning of some of the terms were, or frankly, it was unclear even how to use the computer systems to comply before the first payments were due later that summer. And obviously, this was a real challenge in the middle of the pandemic and the lockdowns and all of that, right when we were all becoming far more dependent on e-commerce and digital services, beginning last March. I think a lot of that's been resolved. But it does go back to that point I made about regulatory transparency and certainty, that when as big a hassle as it can sometimes be for us as bureaucrats, and I've been in this position too, where you're kind of ready to make a decision, but you have to go through this whole process of putting it out there and letting everyone in industry and foreign governments and have their say. As much as that can be frustrating when you're ready to move and it's your idea, it does help you build a better rule or regulation. Sometimes people point out, real problems or factual matters that you weren't aware of. Sometimes there's ways to just improve it, even if it isn't fundamentally flawed. And the statistic I always like to point out is there's a lot of concern that started about 10 years ago about investor-state provisions, and you may remember India actually pulled out of all of its investment bilateral investment treaties, over those provisions. So I'm just going to point out the United States has never lost an investor-state case, and it's because you would lose in court under the administrative laws of the So by the time any regulation gets through, it has enough public comment and notification to basically be impregnable to those kind of investor-state challenges. So I'm not commenting on those provisions or whether you want those provisions, but I'm just pointing out that the protective shield that the kind of regulatory practice and transparency can create once you actually get to a final decision, even if it takes you 3 months longer or 6 months longer. So I'll leave it at that.
Yeah, thanks. I mean, I wish we had the policy technology of ICSID and those lanes in Washington, which leads you to World Bank. All along with World Bank, I think Aditi can be reminiscent of her role at the World Bank as a research analysis. My only trysts have been far and few, and the books on ICSID, which I have bought. But the another connect is the Indiana University bachelor's degree, which Aditi has. And on a personal note, I've always enjoyed her writings in Business Standard. And Aditi, we knew that today is the Monetary Policy Day, and that is why we decided to have this session today. Just one little question I have. I'm great fan of all our Indian diaspora in United States, especially on the economist side. Do you think getting them or would have made life any different? I mean, I'm a personal great fan of Kaushik Basu, so to speak. But anyhow, we are all here eager, waiting for your thoughts. And then we'll have Mr. Vashne. Over to you, Aditi. And thank you for being patiently waiting. And thanks, Matt.
Thanks for having me.
You being very honest and frank as always. Aditi, all yours.
Thank you, Asim ji, and thank you so much, Sachin sir, for inviting me again to share my views. I'll try to be brief. I have some presentation slides over here that I would like to share, and also thank you so much for inviting me to this forum with Vashne sir. Great pleasure to be here today. So just give me a moment, sir. I'm going to share my screen, and please give me a heads up if you can see it now.
Yes, ma'am. It is visible.
Thank you. So this was a really interesting, rather groundbreaking budget. I've been observing the budgets as an economist for more than a decade and a half now, and I must say that this was a very interesting budget. I'm going to quickly present my key takeaways and then get into some of the finer details. So I think this is one budget which we have really appreciated for its very credible assumptions and very realistic numbers that have been put in place for the tax and the non-tax revenues. And one other area that is extremely welcome is the transparent accounting of food subsidies. Moreover, the fiscal space that has been carved out has really been focused on health and infrastructure. One which is going to lead to economic agents gaining confidence to get back into the workplace and really push the economic activity back to the pre-COVID levels, and infrastructure which we think is going to always has the potential to create a better multiplier effect. This year, not only we've seen the budgetary allocation being increased substantially, but we've also seen an enabling environment being created so that there can be better financing which is available for infrastructure, not only through the budget but through the private sector as well. The unfortunate caveat, takeaway, fallout of all of the above is that there has been a sharp slippage in the fiscal deficit. Of course, a slippage was expected because of the pandemic, which led to a revenue shock. But frankly, the deficit and the borrowings have come in a little higher than expected. And in terms of the medium-term path, we do think that the glide path appears to be a little modest and back-ended. And the fallout of that is going to be that the borrowings are likely to remain on the higher side over the medium term, which has an implication for bond yields. And I'll come to that right at the end of my presentation. So here on this slide, we have the fiscal deficit, how the towers have looked ever since FY 2008. And as you can see, huge fiscal slippage in FY21 from the budgeted level to the revised estimate. But I would say that a part of this has been because of the accounting related changes. And we certainly don't expect that when we get the provisional numbers in a couple of months, that there's going to be any negative surprise that will come in. For FY22, we've got a fiscal correction which is coming in from 9.5% of GDP in FY21 to 6.8% of GDP in FY22, partly benefiting from a revenue normalization. However, it's a little discomforting that the number that we're getting for FY22 right now is higher than what we saw at the worst of the global financial crisis. Here I've just broken up for you what caused the fiscal slippage in FY21 between the budget estimates and the revised estimates. And the biggest contributor has been the tax revenues. So if we take away the central tax devolution, which is the third column that we have over here, we get to the net tax revenues, and that has seen a shortfall of 2.9 trillion relative to the budgeted number. Basic, revenue shock that we saw in the first half of this fiscal year because of the pandemic and the lockdowns. Disinvestment receipts, a lot of the planned transactions are getting postponed. They're not closing in the current year. So this is again something that was entirely expected. We got a big shortfall of 1.8 trillion over here. But even on the non-tax revenue side, an almost equivalent shortfall of 1.7 trillion. Very happy to see that CapEx has in fact been revised upward and not downward in this stressful situation. Big increase in the revenue expenditure, a lot of it coming in from food subsidy, partly the free food program that continued till November, and the rest of it is largely related to the accounting treatment for food subsidy in terms of the repayment of the loans that the FCI had taken previously from the National Small Savings Fund. And also under the Atmanirbhar package, we'd seen fertilizer subsidy getting augmented. So that's another reason that we got this big step up in the revenue expenditure in FY21 revised estimates. Just a breakup over here in terms of what fell short on the tax revenue side, mainly direct taxes, both corporation tax and income tax. And on the indirect tax side, we've started seeing much better GST numbers for the last few months. So that's limited the shortfall to 1.8 trillion. And in any case, we've got the huge windfall gain coming in from union excise duty because the duties were increased on petrol and diesel as the crude oil prices came down. And therefore, that has absorbed a large part of the shortfall in the GST collections as compared to the budgeted level. Here, what I've done for you is I have shown you two things. One, the level of expenditure on the revenue side in the 4 quarters, including what is the implicit outgo that we are expecting in Q4 based on the revised estimate, and the pace of growth in each of these quarters. So what you can see here is that the pace of growth has been rather volatile. And in Q2, we saw a contraction, and that was replaced by a high growth in Q3. And the numbers, if we look at the implicit numbers for Q4, that's actually suggesting that revenue expenditure is going to more than double in this quarter as compared to the level in the year ago period. Now this may seem huge, but actually there is a rather large back-ended release of food and fertilizer subsidies to take place. So maybe there could be a modest shortfall in the revenue expenditure, but it's not going to be a huge shortfall in terms of what has been indicated in the revised estimates. Similarly, we also saw a very volatile trend in the capital spending. And for Q4, the implicit level of spending is a very large expansion of 62%. If these numbers end up holding true, then we're going to get a good fiscal impulse in terms of the support to growth in the second half of this fiscal year, which would definitely help the Indian economy to get out of the recession which we saw in the first half. For FY22, now I just want to point out a couple of numbers on this slide. We've got the fiscal deficit, which is expected to come down from 18.5 trillion to 15.1 trillion. And this is largely being led by a normalization in revenue receipts as we get out of the pandemic and the recession situation. So here we have the numbers in terms of the growth for the gross tax revenues, the central tax devolution to the state governments, and the net tax revenues. And if you look at the very last column, which is the net tax revenue growth in FY22 BE budget estimates, what you can see over here is that the growth projected by Government of India is 14.9%, which is very realistic and very much in line with the 14 to 15% nominal GDP growth that we're expecting. So again, I would like to point out that it's a very, very achievable number in terms of what has been penciled in for the tax revenues for FY22. The revenue expenditure is budgeted to decline by 2.7% in the coming fiscal, but a lot of the pandemic related programs are going to come to an end and we're going to get back to a normal level of expenditure. So this is not surprising. For instance, on the food subsidy side, obviously there's going to be a pullback because there is, the free food program is not likely to be there in a non-pandemic situation. And even the fertilizer subsidy will come down because there was a large additional allocation which had been made last year. So if we take out subsidies, the rest of the revenue expenditure is going up by about 2 trillion in FY22. Unfortunately, about half of that, slightly more than half of that, is actually simply coming in from the first item, which is interest payments. So not a very great sort of underlying mix in terms of where the revenue expenditure, excluding subsidies, is going up. But then this is what would happen if the fiscal deficit rose as much as it is expected to in FY21. On a very positive note, we've got this large step up in capital spending that is budgeted for FY22. And we're hopeful that if this takes off quickly, supported by a quick implementation of the other measures which have been announced by the government to support the infrastructure financing environment, then this is something that should really be able to bolster the revival in economic growth which we're expecting in FY22. This slide just sort of gives you a flavor of where we are looking at higher capital spending, and some of it is coming through the road sector and the metro rail sector, as well as the allocation which is being made for the capital support to the DFI which is being planned. Now, as I said earlier, fallout of the crisis and the changes in accounting is that we are getting a fiscal deficit which is much higher than what was originally planned, and also what our estimates were for FY21 and FY22. And by our, I mean my own, as well as what the market was prepared for in terms of the amount of borrowing that would need to be financed in FY22. So for the current year, we got an increase in the borrowing of 80,000 crore, which has been spread out over this month and next month. And for next year as well, the estimate which has been put out for the gross borrowing is 12.1 trillion. My own estimate was about 11.7 trillion, but the market consensus was well below that. So this higher borrowing number for FY22 has definitely come in as a bit of a negative surprise. And despite all of the announcements that the RBI made today, that the RBI governor made today, we did end up seeing yields going up very sharply. And in today's auction, a very large part of the issuance actually has been rejected because I guess the yields that the market was demanding were deemed to be too high. So it's going to be interesting to see where yields settle in this environment between the fiscal slippage, which has now been announced by the government of India, and the RBI, which has clearly said that the liquidity stance remains accommodative in line with the monetary policy stance. So it's going to be a little bit of an uneasy testing time until we get to a new equilibrium as far as the bond yields are concerned. Our guess at this point is that the 10-year government security yield is probably going to end up somewhere between 610 and 620 for the time being, especially, one of the factors that we need to continue to monitor is what happens with crude oil prices, and if that has a significant bearing in terms of the inflation outlook going forward. So that is the end of my slides. I'm happy to take any questions because I know I've been a little faster than I usually am. So please do let me know if there's any clarifications that I need to provide.
Aditi, I had one question. Would the prescription would have been any different if we had the great policy technology sitting in United States, since we are discussing Indo-US, to help the policymakers here on the fiscal and monetary side, because I mean clearly some of them have attained a status of rock star in all good sense, so to speak.
So you're putting me in a very difficult spot. What I would like to say is that as an economist, I completely agree that this is a time to spend. This is a time that the fiscal impulse needs to support the economic recovery. And almost everything that the market could have asked for in terms of the announcements that have been made, we've seen them in the budget. Now it's just over to the implementation to really see how much fiscal policy is able to get us back on track, on a pre-COVID track, and how quickly that can happen. In terms of the coordination between monetary and fiscal policy, I think it's been very good over the last several quarters. We've seen very close coordination between fiscal and monetary policy. Although I must say that in today's monetary policy statement, there is a plea from the MPC members in terms of the high indirect taxes which have been imposed by the central and the state governments on fuels, which is becoming a little bit of a niggling issue as far as the inflation outlook is concerned. But other than that, we've seen, statements today like the RBI governor saying the yield curve is a public good. Very, very strong signals coming in from the RBI that we must ensure that the large borrowing program of the center and the states is taken through in a non-disruptive manner. So I think, in terms of the coordination and, fiscal and monetary policy speaking the same tone, it's been extremely harmonious over the last several quarters.
Okay, thank you. That's very heartening. If there are rock stars in United States, we have Mr. Reliable here in Mr. Varshney. Thank you, sir. I mean, everybody is waiting for you. And you've been very candid and kind enough in saying that please shoot all questions without any being tentative. Ladies and gentlemen, for those of you who are not introduced to Mr. Varshney, although he doesn't need, in my view, he's Mr. Valmiki of the tax policy at this point in time. And more importantly, friends, he's been a part of the UNDP as an expert on helping developing countries in their tax administration. So that's it's a tribute to his tax policy nag. And as I said, personally, I've witnessed few of the UN deliberations in Geneva. Elsewhere, there's a lot of policy technology going on there. Apart from his talented skills on variety of things, I mean, an MBA graduate, a par excellence officer, degree in law. I mean, you couldn't have asked for a better policy head in Norfolk. Sir, to begin with, the retrospective haunt, the goodwill thing has retrospective semblance. Now, is it really, frankly, to scuttle the Horlicks deal? I mean, the media says that the Horlicks transaction of acquisition by Unilever from Glaxo. I know we can't comment on individual transactions, but a 1.3 billion euros deal, was there any temptation? Or because one of the lines in the explanatory memorandum says that, well, goodwill does not really get depreciated. I mean, if you look at brands like Premier Padmani, Videocon, Ambassador car, Nerula's ice cream, goodwill has certainly disappeared. I mean, is it fair? And of course, fairness and equity, I know they do not go hand in hand. Sachin's point on the ever-increasing scope of equalization levy. But before that, your trial and tribulations on challenges on this budget, which was at the backdrop of COVID, some thoughts, and I'm sure our participants would be more than keen. Over to you, sir, and extremely grateful on a personal note.
Thank you, Asim, and personally thankful to you for accepting my request for me to join a bit late, and grateful to Matt for adjusting his time. And one more thing, probably great to know, Asim, that you are alumni of Kennedy School. So next time when you are throwing a cocktail party for alumni of Kennedy School, please don't forget to call me as well. I may not have spent a lot of time at Kennedy School, but still counted as alumni. Okay, so now coming back to the budget part, it was really a very tough challenge for the government. Aditi just covered that how fiscal deficit increased from budgeted 3.5% of GDP to 9.5% of GDP. There would have been challenges before the government, and but still government didn't go for any new tax and have budgeted fiscal improvement from 9.5% to 6.8% of GDP. And most of it is through direct tax collection. Although what Aditi had shown was the consolidated tax collection rising by 14 or 15% in line with the nominal increase in GDP. But if you look at the numbers for the direct tax, the projection is about 23% from current year to next year. So that would of course be a challenge. but we are confident of meeting that challenge, because this budget has, and not only this budget, even the previous budgets, they all have moved in the direction of reforms in both direct and indirect taxes. And this budget has also consolidated those reforms in the form of giving a stimulus to the industry, or in the form of improving tax compliance, making life easier for the taxpayer, providing tax certainty. And some of the proposals that you just mentioned was also on account of tax certainty, because goodwill, I mean, we know how this goodwill had been misused in the past. There are clear provisions in the Income Tax Act that goodwill is not allowable doing business restructuring, but still those goodwills were claimed. And but anyway, I mean, that is whatever taxpayer choose to claim in their tax return. But we were clear, there were clear indication that this provision was misused, and the income tax law, though clearly provided that in certain situations goodwill depreciation on goodwill is not allowable, but still those depreciation were claimed. On the issue of outright purchase of goodwill, yes, Income Tax Act did allow depreciation on goodwill, but there is a thought process which was indicated in explanatory memorandum, which you also quoted, that goodwill may not be a depreciable asset in all cases, just like a land. You did mention a few cases where goodwill depreciated, but that is also a case with the land, that in some of the cases and during some of the time land also depreciate. But in general, land does not depreciate. It either remains at the same value or increase in its value. And if you see business as a going concern, then we have seen that goodwill does not really depreciate. So that is a thought process for not allowing a depreciation on goodwill. And it has been made applicable from assessment year 21, 22. So in a technical sense, I don't think it is retrospective in nature. But yes, it will affect cases where goodwill was acquired through purchase in some of the earlier years. And that is why, and this is a normal policy call. In the past also, we have seen that some assets were acquired and depreciation rates were reduced from high rate of 80% or 60% to 40%. So that will happen, in tax policies. These measures would happen. So yes, from assessment year 21-22, there won't be any depreciation on goodwill as per the proposal which is presented to the Parliament, and that in our view is probably not retrospective. But so this is how the goodwill proposal stands. And I also heard Sachin talking about 147 proposal. I think that 140 proposal is also there to provide tax certainty to the taxpayers. There have been a lot of litigation on reason to believe, and because of that, many times cases were just deleted. All the additions, in such cases or in other cases, were just deleted because of the reason to believe. Similar was the case with 153A assessment and all. So it was a need of the hour that we have a simple system which clearly define what is to be done, and so that we do not have a lot of litigation. So therefore, this new system has been designed for reopening the cases. And yes, if reason to believe has been done away with, there is another check and balance on the assessing officer, because reason to believe was a kind of a check on assessing officer that he should not use this reopening notice in any case that he feels like. There should be some reason to believe. Similarly here, if reason to believe is not there, but there are checks that assessing officer can open a case only when it has been flagged to him by a computerized system. So it's, and that too after obtaining approval of a very senior officer. So one thing is very clear, that government is aware of the fact that there has to be a check so that any case cannot be reopened. And further, the time limit has been reduced from 6 years to 3 years. That is also in the favor of the taxpayer. and new section 148A has been introduced. This is exactly once again for the benefit of the taxpayer. Till today, what is happening is that if I want to open a case in any assessee of any taxpayer, then I will issue him a notice. I will not tell him why I want to issue, why I want to reassess him. And then only when he files his tax return again, then only I will tell him the reason. But now we have said very clearly that income tax assessing officer has to tell the taxpayer what is the reason why he wants to reopen the case, and then so that he can reply to that information, that whatever information he can explain that that is from his disclosed income, and therefore notice should not be issued to him. So this will preempt issuance of a notice without verification. So that process has been properly laid down. This is also once again for the benefit of the taxpayer. So, and yeah, sorry.
Do you think the GK and drive shaft doctrine, which of course was uncodified law, but somewhere was in a way respected
absolutely. Yeah, this GK and drive line case, the High Court had mandated a certain procedure to be followed, but that was not part of the law. Now we have included in the law. So, it's good for the taxpayer that whatever High Court said that this process must be followed for the benefit of the taxpayer. We have included that and have gone one step further, that before issuing notice, we will tell you the reason why we want to issue you a notice so that you can respond. So this is once again for the benefit of the taxpayer.
So one more thought, and I'll come to that issue that it looks like that you've done a helpful definition insertion on liable to tax. Do you think from principle-based, steadily the Income Tax Act is moving to rule-based, and therefore, on one hand, discretion needs to be curtailed, but on the other hand, wherever the principle-based was providing a little more equitable or equity in terms of taxation is being taken away in a backdoor? I mean, do you think that the scales are evenly balanced as we speak?
No, I don't think equity is being taken away from the backhand. In fact, all the proposal, if you say, is for providing equity. Of course, I mean, there are concession tax incentive being given in only some areas, like IFSC to attract foreign investment, sovereign wealth fund, or in the case of startup or infrastructure. So only on those sectors tax incentives are given, but all other sector government is saying that we will not give tax incentive and have a uniform low tax rate for everybody. In fact, that is what is promoting equity and not taking away equity. So I think it's all those are equity is being promoted, and at the same time in the process, use of technology is being promoted so that transparency is increased, accountability is increased, whether it is faceless assessment or faceless appeal. The government is moving the department to a system where the discretion is well documented. Discretion would still be there; it will not be removed, but it is well documented so that the person who is exercising discretion is accountable to the decision he is taking.
So, sir, the liable to tax insertion or definition, do you think is going to help the Indian diaspora in countries, or let's say straight away speaking, Middle East and UAE, where they have a TRC?
I think liable to tax is once again to provide certainty. It is what has been given in the definition is exactly how it is understood in other countries, how it is understood in OECD, how it is understood by all international tax experts. So if you read the definition in any international tax book, you will find the same definition which has been proposed in the finance bill. In fact, Azadi Bachao Andolan also has discussed this, and then Authority of Advance Ruling in Abdul Razak case has also discussed Azadi Bachao Andolan case and Philip Baker writing and so many other factors, and have discussed what is liable to tax. In fact, only after Abdul Razak case, the UAE authorities came to us and then renegotiated the treaty and removed liable to tax in the treaty, because that is how it is understood. So it is better that we know what is liable to tax. So it is better that we provide that in the Income Tax Act so that there is certainty to everyone.
Yeah, so the principles in Azadi Bachao saying liable to tax is a legal concept and payment of tax is a fiscal fact, and that appreciation. So I just hope that this helps in terms of if Indian diaspora has that TRC in let's say UAE, then probably this might just help. Sir, on equalization levy and this 194Q. Do you think, of course, on 194Q, you have a corollary which was introduced last year. Do you think you want to add to more compliances? And on equalization levy, is the temptation is to widen the scope a little more, frankly?
See, equalization levy, I mean, Matt spoke about the discussion part and everything, so I will not comment on that. But equalization levy basically was introduced last year. There was some issues which were not clear in the mind of taxpayers. So clarity on those issues have been provided. So what clarity is proposed in this finance bill is exactly that what was in the mind of the government when they introduced it in the previous Finance Act. So there is, I mean, one can say about the principle behind equalization levy. There would always be discussion, but we need to understand that a concept which has been recognized by all countries, that the concept of permanent establishment has lost its relevance, and therefore we need to move towards a new concept so that digital transactions also get taxed in the country in which they are taking place. Because the non-residents who are doing business in the market countries using technology can participate in the economic life of that country without creating a permanent establishment. And this fact has been acknowledged by all the countries in OECD inclusive framework. But unfortunately, there has not been a consensus on how to tax digital economy. And it was expected last year. It has not happened. We are expecting that it should happen soon, because that multilateral solution is the best solution, which will help all countries to avoid double taxation. And we are committed to agree to multilateral solution and implement that in India. But we need to watch that how the things go in OECD inclusive framework. We have extended our full cooperation there. And but in the meantime, as you know, other countries have done. India is not the only country. There are more than 10 other countries have implemented a sort of digital taxation. There are other countries who are contemplating. So India has also gone ahead, because the wait cannot be perpetual. You know, one cannot wait in perpetuity for OECD to come out with a solution which is acceptable to all. But we do hope that solution is arrived quickly.
So, sir, one last word before I must ask my co-chair Sachin if he has any question and propose a very hearty vote of thanks. Do you think in times to come on international tax policy front, because you've pretty much championed the APA cause in India, and I think the entire country is proud of your efforts, that a tax policy person has to be a tax diplomat to be able to weigh the scales?
See, yeah. I mean, probably it's not a bad idea. I mean, it's you all anyway. You are expected to take into consideration all aspects when you design a tax policy, and that is what the job of bureaucrats is. That when they give advice to the government, that what policy is going to be good for the country and for its citizens. So yes, I mean, what you are saying is absolutely right. All experience would help, to advise correctly to the government about the tax policy. So let's see how it goes. Yeah.
Okay, so, Sachin, before I ask you to make your final word and propose a hearty vote of thanks, sir, one question, and you can deflect it over third man also if you so wish to wish. But why the direct tax task force recommendations were never made public? I mean, that's always intriguing. As I said, you can duck and.
So I think it's just a government call. so I mean, it's entirely up to the government. I can't comment any further. Yeah.
Sir, after the recess break in budget session, somewhere mid-February, if we were to request you to come again, I'm sure you will honor our 200 plus participants.
Yeah, sure, definitely.
Sachin, over to you for your any last question which I have not asked, and for conducting the pleasantries.
Thank you so much, Vashna sir. Just one last question on EL. It seems that by virtue of these amendments that have been made, there could be a possibility that all import transactions which actually cross that threshold might get subject to this levy. That is the fear as a taxpayer that I have. No, okay, I'm not the taxpayer here, but
whether we are tempted to expand the scope of EL, sir.
No. See, purely import transactions which do not meet one of those conditions which have been proposed in the Finance Bill 2021 probably are not intended to be covered. But if there are any concern, maybe there could be some concern on payment or anything. One could consider, we can consider those things and provide clarification, because there is a scope to provide clarification under the Finance Act 2016 for equalization levy. So surely, I mean, if there is any genuine concern, those can be discussed, and we can advise the government accordingly. Yeah.
Grateful, sir. Grateful. So I now have this pleasant task of proposing a very, very hearty vote of thanks, and starting from our president, Mr. Raman Roy, who laid down the theme for this session, followed by Mr. Vasudeva, who gave a very super, I would say, overview of the budget, to Aditi explaining the economics of the budget in a very, very simple format, which at least I really understood very well, to Matt for explaining the whole Indo-US relations and how this budget takes forward and strengthens the ties between the two countries. Vashne sir, as always, we are grateful for the time that you devote to explain all the policy changes. And we are extremely thankful and grateful to you, sir. To the administrative staff of the chamber, a big thank you. And last but not the least, to the chair of this committee, Mr. Chavla. Thank you so much for moderating it so well. And to the participants for joining in. Thank you.
And Sachin, our thanks to our two sponsors and Taxmann channel partner, and to the team at office and secretariat.
Thank you.
Vashne sir, we will certainly see you during the recess break.
Thank you. Yeah, surely, definitely.
Thank you.